Unit 3, Video 2. Picking up where we left off. I set out to make a short video to add clarity to the Idelson's readings. I don't know that I hit that mark given the many iterations of this PowerPoint I've worked through, so I sincerely welcome your feedback on whether this video makes things clearer or less so. So let's begin the discussion with the budget building sequence. The materials we're discussing apply to both organization budgets as well as program or project budgets, cash or accrual settings, revenues or expenses. Let's start with a clean sheet. This is a fictional organization. Figure 1 lists cash revenues in budget format informed by actual history. That history was originally collected in the log depicted in Figure 2, which I'll show you in a minute. Take a look at this figure and note that the table column headers are very simple. There aren't that many, but they are strategic. Actual refers to factual history, budget, our targets for the coming year, and then variance, which is the difference between the two. The notes section offers orienting, causal, or clarifying information in the briefest of terms. You'll note the variance has positive and negative figures. And of course, there's a variance total at the bottom. I know this is elementary and obvious, but we must be sure we are in sync. So Figure 2 illustrates baseline data that populated Figure 1's actual category. This was initially a tracking document and traced revenues by sources and then applied them for use in future planning and performance measures. It's a ledger. There are a number of takeaways to remember for the purposes of strategic thinking from figures 1 and 2. First, as you encounter the work of nonprofit financial management, you'll want to have fluency with the data format and spreadsheet layout, the contents and nomenclature of documents and forms, the history and context of the data, the record of the many small decisions that are made in budget development, operations, year-end closeout, and annual performance measures. And of course, I think the costs to be assigned in this process that you'll take into consideration as an embedded overhead expense in your organization as you weigh the benefits of a particular funding source or an expense source for an organization. There are 3 components to remember throughout the processes of financial management, which I direct your attention as a nonprofit financial decision maker towards. First is tracking transactions, which means bookkeeping or logging and accounting for each transaction for revenue funding coming into an organization and expenditures going out. This kind of record keeping requires transaction discipline and consistency in data entry, but also precision in coding both the revenue and expense transactions for analysis, assessment, and planning purposes. Managing transactions, which mean possessing the ability to modulate revenue with expenses in real time, to take advantage of opportunities and avoid calamities. And then the third thing is keeping the structure simple at the start and creating opportunity to track differences in your budget assumptions with what actually occurs. Tracking these differences is known as variance. And you're going to use variance in judging revenue categories, expense categories, budget performance, and biannual reflection. The rationale for tracking variance really is embedded in Idelson's depiction of performance ratios and benchmarking in Chapter 16. And your experience will sharpen the scales that you're going to be able to use over time. A wise decision maker will track this kind of performance over time and look for causes and effects on a regular basis. So returning to Figure 1 again, this illustrates one way of developing a revenue model for planning a financial management system and making space for variance. The spreadsheet document that includes variance offers a performance indicator. That performance indicator should inform your thinking as you judge and report performance to a funder, your board members, external stakeholders, distant constituents, and other people, that your project met its goals or didn't, while fulfilling its purpose, while reinforcing your original rationale for accepting the project as an opportunity. So that's a lot to unpack, and if you want to replay it, pause here and do that. Over time, that is multiple budget years, performance indicators drawn from variance information will take on greater weight, leading to ever more precise performance benchmarks that you'll use to set financial goals in the future. But as I mentioned before, also to modulate and manage your budget as you go along in real time through the budget year. Tracking variance in your data sets can deepen and will deepen and proceed to ever more sophistication. So to illustrate budgeting, tracking, and managing documentation record keeping, I'm going to share 3 spreadsheets that you will find in a single Excel file on the SHU Blackboard support materials for this class. The next slides offer partial reproduction for illustration. The documents are codes for expenses and revenues, 2018 check register, and a multi-year performance comparison spreadsheet. So this is a little small, but the check register started as a simple log with columns for the date, description, and amount. Later columns were added for codes to assign searchable variables that I could use to analyze revenue and expense types. And then, of course, there's space for notes, which I also added. It was then necessary to create a chart of codes to define the codes. These codes were applied initially to revenue types and then to expenses, and illustrated in this slide. And the interesting thing is, the increasing sophistication of the initial log required me to develop these codes. I think you'll see them. They're common as a standard practice in most fiscal documents, but it was kind of neat to have to do it and necessary. So if you take a moment to pause the presentation and look over the format and the content of the slide, we'll wait till you proceed. The last data table is designed to reflect annual performance in a manner that will report trends. So if you're following, this slide has to do with the previous 2. This next slide 11, is a year-to-year comparison. I didn't put variance into this because I think that's something I would expect you to do. And also it had to fit on one sheet so I could present it to you. So take a moment to pause at this and look over the format and the content and think through what it's communicating. So the next slide, financial management can move very quickly from simple arithmetic to complexity, requiring professional accountants and finance people. Public sector supplied funding has the added advantage of bearing the weight of law, and therefore innocent errors carry the gravity of breaking the law to the point potentially of a federal crime, depending upon the source material. So you really want to remember these concepts. So here are 3 quick concepts for financial management processes. First, the initial budget we devise should take into account ease of understanding because it must be approved by a board of directors or, if a project, an executive. Second, tracking and managing the budget as it unfolds in real time requires a commitment to accuracy, openness of detail, and steady tending. And then third, analysis to inform future budgeting starts with variance. Then, of course, there are exceptions, unanticipated conditions, and other problems that contribute to performance variance, just to name a few. So what I'm saying is you don't want to take shortcuts with your structure, your approach to financial management. The impression that I want to leave you with is that there is no single way to carry out this work, and there are many pitfalls. Some takeaways for our discussion going forward: cost-benefit analysis is a process touching on each aspect of budget building. Complexity increases with time and experience. Documentation is an essential element to a budget development, management, strategy, and communication. And financial management overhead can't be avoided and is the cost of doing business, literally. In doing your assignments for this week and supporting your written briefing memos, I'm looking for clarity of writing, a spreadsheet that's understandable for someone like me who's unfamiliar with the organization you're reporting, and pretty much your mastery of these concepts. That's it. See you soon.